we skipped the break, so thanks for bearing with me. 25 minutes on exchange rate basics. We talked a little bit about exchange rate regimes this morning. Now we talk about spot and forward exchange rates. What is a spot exchange rate? Well, a spot, let me switch this on. A spot exchange rate refers to a transaction that involves immediate delivery of currency at time t. Now, very generally, when I go to the Bancat street market and buy a mango, and I get the mango and I give the money, that's a spot transaction. Now, a forward transaction looks as follows. Suppose I go to the Bancat street market, and suppose I speak Vietnamese, and I say to the lady selling the mangoes, I say, I want to buy a mango. And the lady says, then pick a mango. And I say, no, wait a minute. I want to have the mango in 6 months. And then the lady says, well, then you come back in 6 months. And then I say, yes, but I want to fix the price today. I want to fix today a price for something that I will pay and get in 6 months. And that's a forward contract. A forward contract is you agree on a price today, but payment and delivery takes place in a week, in a month, in 3 months, in 6 months, in a year. Now, on foreign exchange markets, this is not unusual. So you can actually buy currency forward, which means that you don't pay anything and you don't get anything today, but you're fixing the price, which we will have to pay in the future. Now, why do we have such a thing like forward markets? Well, suppose you are selling something to a foreign customer and you grant the customer the right to pay in his own currency. So suppose you're selling something to the United States and you grant the American customer the right to pay in US dollars. Now, you may have sleepless nights because the Vietnamese dong may depreciate, then it's good for you because you get a lot of dong for the dollars that you will get. But the Vietnamese dong may also appreciate. If that's the case, then you may get very little dong for the dollars that you get. So there's exchange rate risk. Now, forward markets were introduced to eliminate exchange rate risk. Because what you can do is you can, suppose you're getting $50,000 in 6 months. You can sell those 60 months, not the 6 months, the $50,000 today on the forward market, which doesn't mean that you get that you have to deliver any dollars right now and you don't get any Vietnamese dong right now, but you know the price that you will get in 6 months. And if there's some contracting party on the market that says, oh, that's exactly what I want because I want to sell Vietnamese dong and buy dollars in 6 months, then the deal is done. So that's the nice thing about forward markets. So this is something that's pretty old. The Financial Times in the good old past put this on the internet, these tables. And how do you read that? This is Euro spot forward against the euro. And let me pick out the Swiss franc. So this was in the good old times, June 11, 2010. The amount of Swiss francs you had to pay for 1 euro, this is backward looking, this was on June 10, 2010. So on June 10, believe it or not, you had to pay on the spot market 1.38 Swiss francs for 1 euro. Now suppose you wanted to buy the euro 1 year ahead. So suppose you said, I don't want to have I'm a Swiss buyer, I want to buy euros, but I want to have the euros in a year. I don't want to have them today. But I want to agree on the price that I will pay in a year. Now, since these are very liquid markets, we can report the prices that were paid on average for these forward contracts, 1-year forward contracts. So the contract takes place, or the contract is the price is determined on June 10, 2010, but delivery and payment takes place on June 10, 2011, and the price in terms of Swiss francs that you pay for 1 euro was 1.3737. Now this is an interesting difference. It's not a huge difference, but just imagine the volumes at stake in foreign exchange markets. So apparently, if you bought euros on the spot market, you had to pay more. If you bought euros forward on the forward market, then you had to pay less Swiss francs. Okay? And this is about payment and delivery in 1 year. This is what a forward contract is doing. Now let me turn to the first important relationship that we know about that we can use this for, which is so-called covered interest parity. Covered interest parity says if there is perfect capital mobility, so you can buy and lend arbitrary magnitudes in foreign exchange, and if the domestic currency offers a risk-free interest rate of IHT and the foreign currency offers a risk-free interest rate IFT on investments made at time t and due at time t plus 1, then the forward rate with maturity t plus 1 is given, and the forward rate with maturity t plus 1 is given by FT, then this relationship has to hold. Right? So this is that's the domestic currency return on domestic currency assets. This is the foreign currency return on foreign currency assets. This is the forward rate, this is the spot exchange rate. Now, why is that? Well, the point is, if this didn't hold, you could make a lot of money without being courageous, creative, or smart. Right? And what's the point? The point is, okay, let me give you an example. Suppose that covered interest parity is violated. Suppose that 1 plus ITH is smaller than 1 plus ITF times FT ET. Suppose you switch on your computer in the morning and that's what you observe. What would you do? Well, step 1, borrow X domestic currency units borrow X on domestic markets, right? Step 2, turn X into XE foreign currency units. Right? So suppose you're borrowing 1,000 euros and you're turning this 1,000 euros into 1,000 divided by E dollars. Step 3, invest XE on foreign market return is, or get X over E 1 plus IT, well, I have no time subscript, so 1f at maturity. Right? That's what you get. So this would be, you have X over E dollars, you put them into US Treasury bonds, and what you get is X over E times 1 plus IF. Now, step 4, sell X over E 1 plus IF on the forward market. Which gives you F times X over E 1 plus IF domestic currency units. So what is the payoff, or what is the return on this strategy? The payoff on this strategy is the following. Or say, let me call it the profit, is you get F times X over E Y plus IF, and then of course you have to repay 1 plus IH X because that's what you've borrowed. And that in turn gives you X 1 plus IF F over E minus 1 plus IH, and this is greater than 0 if 1 plus IH is smaller than 1 plus IF F over E. So how many euros would you, how many domestic currency units would you borrow? As much as possible, right? Would you incur any risk? Answer is no. Why? Because there's no exchange rate risk. Because you're going to the foreign currency, you know the returns that you would get in foreign currency terms, and you're selling the stuff immediately in the forward market. So you can put yourself to sleep and be completely relaxed. There's no exchange rate risk whatsoever because there's a forward market. Now, usually in economics we say if you can make a lot of money without being creative, courageous, or smart, then everybody wants to do it. Now, if everybody wants to do it, then prices adjust immediately and the arbitrage window closes. So this is called an arbitrage window, right? And just imagine a window and everybody wants to jump out of the window. 1,000 people, then it will be clogged. So the logic behind covered interest parity is that such a situation like the one that I'm describing here doesn't prevail for too long. It'll probably go away. And then the equilibrium should look like this. Now, the interesting thing is that after the global financial crisis, this thing is not as rock solid as it used to be. So we see large deviations from covered interest parity, indicating that people are holding currency even if they could basically, even if they're missing large arbitrage opportunities. And this is a big topic of current research. Why do we see deviations from CIP? That's a pretty recent phenomenon. It hasn't made it to the textbooks yet, right? I have a graph in my textbook. Let me check. No, I don't have it in here. I have a graph in my textbook where I show that during the European debt crisis, there was a couple of months when there was a pretty large deviation from CIP, in the Swiss franc euro relationship. And I argued that this was because there was this turmoil in the euro area, and that's why people wanted to hold Swiss francs, although the return was lower. And I thought this was just a one-time incident, but in fact, researchers have shown that there's actually quite substantial deviation from CIP recently, and that's something that is interesting. Now, let me show you one more thing, and I hate to erase that because it looks so nice. So your handwriting is much nicer than mine. Let me show you something more, which is very useful. Economists love to multiply. Economists hate to multiply and to divide, but they love to add and to subtract. Or put differently, we love linear equations. We don't like nonlinear equations. Now, the CIP equation is a linear equation, nonlinear equation, right? It's not right? It's a nonlinear because we multiply and divide instead of adding. So how do you turn something that's nonlinear into something that's linear? Exactly. The log function is the biggest friend of the economist because it allows us to turn something that's nonlinear into something that's linear. So we take logs on both sides. And call this ft and call this lowercase et. And now here's a fishy little thing, which, however, we allow ourselves to do. We say this thing here is close to ITH, and this thing here is close to ITF. So check it out. The log of 1.05 is close to 0.05, and the log of 1.02 is even closer to 0.02. So, as a consequence, we have ITH close, or let me, the log approximation of the uncovered interest parity condition is ITH equals ITF plus ft minus et. Okay? And this equality sign is a bit, dubious because, we are approximating here, we're approximating there as well. But by the end of the day, it turns something that's nonlinear into something that's linear. And this is actually, if you go to finance books, that's the way they present it, without further discussion. Good. Now, let me take a sip of tea. And let's take the last hurdle. Okay. Now, if this future spot exchange rate can be perfectly predicted, and if the conditions for covered interest parity are satisfied, market equilibrium requires that this is the case. So suppose that you have a crystal ball at home, and you ask the crystal ball, what will be the US dollar Vietnamese dong exchange rate from now on in a month, say on May 10, 2025. And the crystal ball says the US dollar Vietnamese dong exchange rate will be, and gives you a value. And you know for sure that this is correct. And suppose everyone has a crystal ball. right? Everybody can perfectly predict the nominal exchange rate. Then, of course, we can easily replace the forward rate by the future spot exchange rate because everybody knows that. And this has to hold because people could do exactly this thing with the only difference that they don't sell this on the forward market. They just wait until they collect this, and then they change it back into the domestic currency at the future spot exchange rate. And they don't have sleepless nights because they can perfectly predict the spot exchange rate if they have a crystal ball. Now this sounds super silly, right? And so let me just give this more substance. I mean, we do have situations where we can perfectly predict the spot exchange rate, namely when we have a credible peg. So a fixed exchange rate that's expected to prevail in the future. In that case, the nominal exchange rate doesn't change. So ET plus 1 equals ET. Now, that is interesting because, of course, if we have this equation and this is equal to 1 for a fixed exchange rate, then this means that 1 plus ITH equals 1 plus ITF, and this in turn is equivalent to saying ITH equals to ITF. Now what does that mean? It means that if you're pegging the exchange rate against some anchor currency F, and you are a smaller economy, you're dancing after the tune of the monetary policy in the anchor currency. That's the famous or infamous macroeconomic policy trilemma. So uncovered interest parity implies that with perfect capital mobility and a fixed exchange rate, the following condition has to hold. So if you have perfect capital mobility, and if you have a fixed exchange rate, then you cannot set your own monetary policy. That's the implication. If monetary policy is about setting interest rates, your interest rate has to be equal to the foreign interest rate. So, for example, the Danish kroner is pegging against the euro. Now, Danish monetary policy is pretty boring because what the Danish central bank has to do is it has to follow the European Central Bank. Same thing for the Central Bank of Bulgaria. Bulgaria also having a peg against the euro. So a small open economy with perfect capital mobility and a fixed exchange rate cannot set its own interest rate. That is, it has to give up monetary independence. Now, this may be exactly what you want. Bulgaria had a hyperinflation in the mid-90s, and the hyperinflation was driven by reckless monetary policy. Now, how did they tame that beast? Well, by fixing the exchange rate in a very credible way, having a so-called currency board, and since then, inflation rates in Bulgaria have been rather small. So this is sometimes called the macroeconomic policy trilemma or the impossible trinity. So that's the picture that's often shown in textbooks, right? You have monetary independence, exchange rate stability, and perfect capital mobility. And so if you pick a combination of perfect capital mobility and exchange rate stability, then you cannot have monetary independence. You cannot set your own interest rates. The domestic central bank is not free to run its own show. Now, during the Bretton Woods era, countries did have monetary independence and exchange rate stability, but that was because capital mobility was very limited. Or you could say you have monetary independence and perfect capital mobility, then you are here, but then you cannot have exchange rate stability. Then you must have a flexible exchange rate. With a flexible exchange rate, you can do your own monetary policy. That's a good thing. or a bad thing, depending on whether you want to tie your hands. So there is an ongoing debate on whether the macroeconomic policy trilemma is supported by the data. There's some people arguing that even countries with flexible exchange rates are pretty much following US monetary policy, but the concept is an important benchmark. Well, the last thing I want to show is this. If the future spot exchange rate cannot be perfectly predicted because you have a flexible exchange rate, agents have to base their decisions on their expectations. Now, if agents are risk neutral, they borrow and lend to maximize the expected return, and in that case, the uncovered interest rate parity condition has to hold, which says the return on domestic currency assets has to be equal to the return on domestic foreign currency assets times the expected future spot exchange rate divided by the current spot exchange rate. Now, this thing is something that you expect, right? Could be that the realized value is above it, could be that the realized value is below it, right? So you are exposed to risk. Now, what does a risk-neutral person say when you confront him with risk? The risk-neutral person says, I don't care, right? That's risk neutrality. Let me give you an example, and then suppose I'm offering you a lottery, and a lottery has two payoffs. One payoff is, let me put this on the whiteboard. So there's a lucky payoff and an unlucky payoff. And there's lottery B and C, and both you have a 50% chance to be lucky and a 50% chance to be unlucky. So the first lottery offers you 50, say, dollars when you're lucky, and $50 when you're unlucky. Okay? The second lottery offers you 200 when you're lucky and 100 minus 100 when you're unlucky. So you have to pay 100 when you're unlucky. You get 200 when you're lucky. The third lottery offers you 201 when you're lucky, and you have to pay 100 when you're unlucky. So let me put this up for a vote. Who would take lottery A? Right? Okay. So just this is not an exam question. Just suppose you're confronted with that. Right? Here you get 50 in both states of nature. Here you get 200 when you're lucky, minus 100. You have to pay 100 when you're unlucky. Here you get 201 when you're lucky. You have to pay 100 when you're unlucky. So who would pick one? Who would pick lottery A? Okay, 4. 1, 2, 3, 4. Who would pick lottery B? Okay, who would pick lottery C? Okay, now what's the point? And the point is the following. What's the expected value of this? What's the expected value here? 50. Now, why did you pick this instead of that?
Because I don't have the money to pay if I lost.
All right, but let me put this in more, technical terms. You get the same expected payoff, but here you're exposed to risk, there you're not. So you are risk averse, which most people are, right? Now, a risk neutral person would not know how to decide between these two payoffs. I'm showing this to you because I want to illustrate how strong the assumption of risk neutrality is. A risk neutral person being confronted with A and B would say, I'm indifferent. It's the same because it's the same, has the same expected value. Now, what's the difference between C and B and A? Well,
Highest expected return on C.
right, it's slightly higher expected return. In fact, this is 50 and this is 50.5. Now, a risk neutral person would certainly go for this. It would never pick that or that because it would go for this because it would say this has the highest expected payoff. All right? So risk neutrality means you just go for the investment alternative with the highest expected payoff. And this is what we're putting into uncovered interest rate parity, right? And this is an important assumption which you might of course debate. Now, if you're willing to swallow that, then, and if we assume that everybody's risk neutral, then this has to hold. Not because people can do arbitrage, because if there's risk involved, there's no arbitrage, but because people are risk neutral. They go for the highest expected return, and if this is smaller than that, right, they will never put any money into domestic currency assets, and if this is bigger than that,